Oh, sorry. I was just watching the market crash. Hello and welcome to Cheppy Today. I'm Will and we're going to be going through some of the most talked about topics in crypto. If you want to be kept up to date with the discussion, remember to give a like and to subscribe. So it's hard to look away from the charts right now. Sorry, a bit of popcorn. Bitcoin has fallen to a new yearly low days after it hit a yearly low. This further dip is most likely propagated by the Bitcoin Cash hash war, but interestingly, according to analysts from the Bank of America, the sell-off is indicative of something bigger. According to the bank, this is a movement out of risky assets such as oil and crypto. They also believe that due to various triggers, such as bond and equity volatility trending up, the wider global markets could be in for a flash crash. So flash crashes are often due to the heavily computerized trading algorithms reacting to heavy selling and producing a rapid drop in price. Whether or not this is the case remains to be seen, but one thing is for certain, and that is volatility is back. That's right, it may not be taking us in the right direction, but it is back. After a nearly 16-month lull in volatility, Bitcoin finally woke up and did something. Just not the thing that everyone wanted it to do. Having said this, volatility often works two ways. So a heavy downturn could potentially turn into an upswing pretty rapidly. At least that's what I've been telling myself. So Meltem Demirors, the CSO of CoinShares, recently typed out a tweet storm in which she addressed the volatility, or as she calls it, the crypto financial crisis. Within the tweet, she cites hugely depressing figures, while simultaneously saying that everything's basically going to be alright. She starts by urging us to look away from the fact that prices across the top three cryptocurrencies, Bitcoin, RXP, Ethereum, are down by 70%, and that trade volume is non-existent in over 80% of cryptocurrencies. I warned you it was depressing. But instead of focusing on that bad performance, she points towards companies serving these cryptocurrencies. Companies such as Circle, Binance, and Coinbase, whose unprecedented growth can no longer go ignored by these large financial institutions on Wall Street. Demirors adds that we can no longer rely on retail investors to prop up the market. Instead, we need to set our aims to the institutional interest that's coming in, as these institutions look for new ways to create revenue, innovation, and build enterprise within the space. She concludes by adding that inevitably value will be derived from these financial entities and end up circling within a more decentralized financial system. So as Demirors points out, the cryptocurrency industry is still in its infancy. And with a total market cap of under 200 billion, which is less than some companies that currently trade on the stock exchange, there is still an enormous potential for growth. And it's probably true that in order to get there, we're going to need some help from the heavy hitters, such as Bakkt, Fidelity, the CME Group. But these are just the start.
And now for something completely different.
So next we have the news that the SEC ordered two companies to recompensate investors that took part in their ICO. So Paragon Coin and Cara EQ were both fined $250,000 for not registering their ICO with the SEC, as it was deemed that their token was a security. And the SEC has now ordered the two companies to reimburse any harmed investors. This kind of sets a scary precedent for ICOs, both past and future. The statement from the previous SEC Commissioner Jay Clayton was that most ICOs are securities. But this ambiguous classification will inevitably leave a lot of ICOs open to these kind of class actions. The SEC currently uses the Howey test to decide whether a digital asset is a security or not. The test uses four deciding factors, including an investment of money in a common enterprise, an expectation of profits from said investment, and if those profits come from the efforts of a third-party promoter. It's been argued that this kind of test is too outdated for cryptocurrencies. After all, it was made in the 70s. Furthermore, if an asset doesn't fulfill the criteria, then it can't really be classed as a security. There are many that would argue that cryptocurrencies are both decentralized and open source, and therefore don't have a third-party promoter and don't fulfill the criteria fully. Unfortunately, there's not a lot anyone can really do about it without the appropriate regulatory guidelines in place. In lieu of that, it seems we're going to continue to see the SEC prosecute companies they deem to be in violation of their fairly arbitrary and outdated laws. But as always, we'd love to hear your take on the stories discussed. What do you think of the SEC refunding ICOs? What was your take on the market crash? So leave a comment, leave a like, subscribe, and we'll see you next time.